Thank you, and good morning to our audience. So I'll just start with a quick introduction. My name is Shadrack Mella. I work for a company called AIRE, where I head Valuation Advisory for Africa. So I'll give my panelists an opportunity to introduce themselves, and then we will get into the discussion on ALP.
Hi, good morning, everyone. My name is Cynthia Mbaru. I work with Dyer Blair Investment Bank, and we acted as transaction advisor for the ALP Industrial REIT. Thanks.
Good morning, everyone. My name is Barrack Mandela. I serve as the General Manager for Investments and Strategy at Africa Logistics Properties, the promoter for this particular REIT. Thank you.
Excellent. All right, so my first question will be to Barrack. So Barrack ALP has been a fast mover, or was a fast mover in sort of like grade A logistics in Kenya. Yep. I think over the past 10 years, you have delivered LP North, LP West, cumulatively about 70,000 square meters of grade A logistics and warehousing space, and another, say, 20,000 in the pipeline. So maybe you can tell us, from where you sit, why was an income REIT the right vehicle for LP at this particular moment?
Yeah, thank you, Shadrack, for that question. I think it just goes back to what you've pointed out. So a brief history of LP. We have been in the market for the last 10 years, and within those 10 years, we have not only developed, institutional grade industrial real estate, but you have also managed those assets over the last 10 years. And so it became important to try and fully integrate the platform, introduce a fund management vertical into the platform. And that fund management vertical would introduce much needed circularity of capital back into the platform to enable us to do more. Real estate is capital intensive, capital is finite. And so for us, that fund management vertical only made sense to introduce that much needed circularity of capital to enable us to continue developing and managing assets that would feed into these income REITs that you're bringing into the market.
Right, and in terms of just maybe as a quick follow-up question to that, if you look at the story, or rather, we've heard Ruth speak to us about she being the pioneering REIT with Stanlib, and which later became Ilam. Maybe just what are some of the key learnings that you've taken from the currently listed REITs that have been instrumental in sort of you structuring LP REIT?
Yeah, I think for us, given the history that also, when it comes to some of the people that are currently in LP, we have had the privilege of launching other REITs in the market. I would say one of the key learnings for us is to try and go back to the main market. Ruth has spoken about liquidity and the fact that most of the other REITs, finding buyers and sellers has been, a bit of a challenge. And many of them have been, on the USP, which is an over-the-counter platform. And so for us, we made that decision at the very beginning to be on the main market, which would ideally, leverage on the liquidity of the main market, but also on the side, what we also made a conscious decision on is to stick to the institutional capital, which would not be looking to have a quick in and out, which now starts playing into the price of your unit. So I would say that has been one of the key learnings for us, and it's a decision we made at the very beginning to actually be on the main segment market of the NSE, albeit with a few restrictions so as to try and limit that volatility of the price.
Right, great. You're giving me opportunities to ask you further follow-up questions, but let me pivot to Cynthia for now. So Cynthia, you're the transaction advisor for the LP REIT, the project manager, just overseeing everything and putting everything together. I recall at the REIT incubator event for the REITs Association of Kenya last year in October, you spoke in a lot of detail about, what the challenges and that sort of like issuers have faced, and what you think they need to have in place before coming to market. So maybe you can speak to us about the key ingredients for issuers and promoters before they bring these REITs to market.
Sure. I think we can narrow it down to three items. I think the first one is the REIT management team has to be experienced and have track record. They need to really know a lot about the real estate sector and even the niche that they're playing in, so that they can actually do the work that investors are not able to do themselves, which is do the due diligence, understand the returns, and then also be able to deliver those returns. So the first thing is, how much real estate experience do you have? Have you managed a REIT before? If not, have you been a developer? How many projects have you developed? Or if you're managing income generating assets, which ones have you managed, and do you know how to optimize? So that's the first one. The second one, which is very critical, is the returns have to make sense and your projects have to be viable. So once you account for the property costs and then the fund costs, what are the returns that you'll be delivering to investors? And in Kenya, investors are very focused on dividend yield, cash yield. So they want to know at the end of the year, how much money am I getting? And so that figure has to be very attractive and has to be very clear. So if you do all the work and then your returns are, say, 4%, and that's our cash yield, that's not going to go anywhere because some of your institutional investors are actually struggling with properties which are yielding 3-4%. So you need to start looking at the 8-10%, and now that has to be a figure that is verifiable and you can deliver it as well, because there's nothing worse than saying you're going to deliver, say, 8%, and then now when you start doing your first dividend distributions, you're actually delivering 5-6. You'll now have a problem when you now want to raise capital or bring in more property because you've not fulfilled your promise. So the returns are quite critical, and how sure you are that you can deliver them. And that also touches on the experience of the management team. The last one, which is also quite critical, is REITs really need scale to really survive and get the full benefits. Because once you have scale, you've got economies of scale in terms of costs. From an operational perspective, your management team doesn't have to increase in size if you're managing 10 properties versus 20. So from a REIT strategy perspective, the assets need to make sense. So you have your seed assets. How many are they? You can start with a few, but then you need to be able to show us where your pipeline assets are going to come from. So one of the challenges we see with issuers is that they look at a REIT as an exit mechanism for themselves. So I have this property portfolio, I need to sell it, let me do a REIT. But what happens after that? And why would anyone want to invest in that? So you need to be able to see where the pipeline will be, where the strategy will be, and how you're going to grow. If you don't have any of these, you'll find that you will struggle, A, coming to market, or B, even attracting investors.
I think that's an excellent response, and you've summed it up very well. Experienced management, attractive returns, and what was the last point? Scale. Right, yeah, so that's very clear. And maybe it's a good opportunity to segue into the hot can of worms that Truth opened here about valuations, because I'm looking at my two friends, Joanne and Philip, in the audience. And maybe I'll just make a point around, as somebody who is in that space and the kinds of challenges that we also see. And I mean, look, it's a market reality. In the panel yesterday where Timothy from Gen Africa was speaking about Batian Property Fund, he spoke about having looked at 150 properties before they made the acquisition of the asset that they made last year, the Cube, which is public information. And I think I tried to ask him about if he can highlight some challenges that he faced, or rather, what are the key sort of stumbling blocks to these deals happening. And he just said that pricing mismatch between buyers and sellers. So from the outset, you do have owners who have very, and I'll put it this way, like in the context of Kenya, compared to, say, mature markets that have more institutional players, there's, say, a sentimental attachment to some of these properties. So sellers are not what I call motivated sellers. So a motivated seller really wants to sell the asset at the best possible price that they can get in the market. When you don't have that, then a transaction is not happening. Secondly, Cynthia has mentioned yields or distributions of about 8 to 10%. So from a yield perspective, or from a property valuation perspective, now you've not even accounted for fund level costs. Barrack is smiling. And you are at the range of property level valuations of between 8 to 10% yield. So you can see the conundrum that creates as far as distributions in REITs is concerned. But I just want to maybe come back to you, Barrack, and we'll speak further about valuations, I'm sure. But I wanted to just understand why was this the right time to sort of bring an industrial and logistics REIT into the market?
Thank you for that question, Shadrack. I think for us, the timing, one, you look at what underpins the logistics sector, and we do believe that in this particular market and the wider East African region, we are at an inflection point when it comes to supply chain, the trade volumes, distribution hubs. You've seen all the infrastructure that has been put in on all transport corridors, not only in Nairobi, but that's extending now into Uganda, Tanzania, and the likes. And with that movement of goods and services, you do need better supply chain compared to what we currently have. And that's the sector that we play in and will continue to play in into the future. So on one side, we do believe that growth will lead to more investment into logistics, which is the area that we play in. But then also looking on the other side, the previous panel, I think it was Casada Capital, spoke about alternative investments. And for us, if you look at industrial real estate, it plays into the alternative investment space. Now, if you bring that home to a REIT, underpinned by logistics and industrial real estate, and in this case, institutional grade industrial real estate, you are bringing an asset to the alternative space, which is much needed, especially in the context that we currently sit in. So for us, why we came into the market, I'd say at this time, one is that much needed additionality in the alternative space. And this is underpinned by, if you just break it down to what we are seeding into this particular REIT, you have long-term leases. I mean, we have a runway of over 5 years. Our WALT is actually around 63 months. You look at our leases are dollar-denominated, and that's part of the reason why we are able to give investors a cash yield of 7 to 7.5%. And there is an additional, income appreciation to it. And the other bit, in as much as I know on the previous panel, they touched on it, and Cynthia can also mention to you when we had our roadshows, one of the questions we always got asked is, how do you compare to government bonds? If you compare what we are currently seeing today versus, what we had, let's say, 3 years back or 4 years back when infrastructure bonds were at 18, 19%, that has come down to around 13%. Your T-bills are somewhere around 7 to 8%. We are offering a cash yield of 7 to 7.5 to the dollar, and we believe that is competitive, even when you're trying to compare to, be it government paper or other asset classes. So for us, this just everything lined up with it being the perfect time to bring this innovative issuance to the market.
Yeah, so you'll be scaling to those 10 assets that Cynthia spoke about, yeah?
Yeah.
Excellent. All right, so maybe coming back to you, Cynthia, just around what this transaction might mean for not just our capital markets, but the larger East African capital markets. Of course, capital markets, East Africa, still very thin. Penetration is still very low. Participation and market understanding is still very low. I think for REIT regulations, if I don't know, Ruth can correct me if I'm wrong, but the East African countries, I think between 2011 and 2017, Kenya, Uganda, Tanzania, even Rwanda came up with some sort of initial REIT regulations. I know in Ethiopia, for instance, after their CMA licensing, market participants last year for stock brokerage and brokers last year, I think they're having conversations about setting up a REIT, from what I've heard from RAC. So maybe, Cynthia, you can speak to what you think such a transaction, such a successful REIT that seems to have been delivered successfully with returns that seem a bit more promising, what that means to the capital markets.
Thanks, Shadrack. I think the fact that we were able to actually bring the REIT to market was a testament to the regulators and the regulatory environment. We actually have very accommodating regulators in the CMA and the NSC. So when we first went to them and said we actually want to do the first US-denominated listed security, CMA saw there was no issue with the regulations. They just said, talk to NSC, CDSC, check if they need to change anything in their regulations. If they do, let them come to us quickly so that we can actually give those approvals. So when we engaged with the NSC and the CDSC, CDSC is a depository, their regulations actually had already allowed for multi-currency trading and settlement. So what we had to do was sort of help set up the plumbing of the system. So get the brokers to set up settlement accounts, and CDSC had to engage CBK to get the custodians and the settlement banks to actually set up USD accounts. But what you found was it wasn't a regulatory issue that we were dealing with, it was more operational. And then when it came to investors, investors were already exposed to USD denominated securities through unit trusts and fixed deposits. So this was just a way for them to actually diversify and actually access USD securities in Kenya, because you found that a lot of investors were investing in Eurobonds. So we found that we didn't have to do too much in terms of change what was in the regulatory environment. A lot of it was just exposure and information, letting people know that this was actually possible. And we were able to come to market. We were able to raise from high net worth investors, insurance companies, pension schemes, and then to anchor investors. So we actually had a very diversified investor base. And I think what's happened after that is it showed people that, A, you can come to the capital markets with a different currency. It's also showed that for East Africa and Uganda and Rwanda, they are now looking at Kenya to sort of help guide them in terms of REIT setup as well. So I think it's really one of the pioneering transactions. And I think what's interesting is that ALP came even before government, because government was also considering doing a local denominated dollar instrument. So I think it's just paving the way. And then we now also have a terrific REIT, which is coming after us as well. So sometimes I think in terms of school fees, we may not have paid them the way Fahari paid them, but maybe on the USD side, we are able to at least pave the way.
Yeah, and so it's interesting you mentioned, Terrific, who I think have their offer has just opened yesterday for about a month. Another dollar-denominated REIT, and maybe it's a good sort of opportunity to speak about currency, for instance. So you have two back-to-back USD dollar-denominated REITs, and of course they're denominated that way because the cash flow itself is of a dollar base for you guys, and that's what your tenants sign up for. I guess for Terrific, given sort of like their tenant base and who they're targeting, it's a dollar income as well. So from sort of your standpoint, Cynthia, as a transaction advisor, when you have that context of sort of a preference for the dollar-denominated, these two dollar-denominated REITs that seem to be offering a much better return, what do you think that means for other REITs looking to come into the market that would be in other sectors? If you think about an office developer or a portfolio owner or retail, I mean, we've seen attempts to charge dollars for retail tenants here, and I think it's not been very successful. It's difficult to sort of execute when tenants are earning earning their revenues in cash and paying in cash. So I don't know what would you have to say about that in terms of future issuances?
I would say that you need to match your revenues to match the currency of your REIT to the revenues that you're going to be getting. In ALP, they're not doing any conversion. They're earning in dollars. And then when investors were looking at the tenants and doing the due diligence, they could understand how those tenants were able to actually pay in dollars. So I would not advise any REIT to now convert into dollars if your revenue's in cash. You're just going to create a huge mess. And you're just going to get forex exposure, and there's a lot of volatility that can come. Maybe not in year 1, year 2, but maybe year 3. So I would say if your leases are in dollars, you can consider a dollar REIT, and we just look at the costs and make sure the returns make sense. But if your leases are in cash, stick to cash and make sure you have cash returns that also make sense. So I think that would be the key thing, yeah.
Okay, excellent. So maybe as we try to wind up, Barrack, you can just speak to the kinds of trends that you're seeing that are driving demand for modern logistics space in Kenya and maybe East Africa to a large extent.
Yeah. Thank you for that question, Shadrack. So to just speak on the trends, and I'll mention 3 points, and more, all of them kind of just tie together. So one is we have seen formalization of that supply chain, and what that has meant is you have tenants who are moving from your largely fragmented go downs that are prevalent in our market into well-developed, professionally managed warehouses, which is where we currently build for. The other key trend I'd like to point when it comes to demand for logistics is there has been an increase in, I'd say, e-commerce. I know in Kenya it's still a bit nascent, but then again, you look at also FMCG sector, and within the players who are in that particular space, what you will see is a lot of these players are now looking at operational efficiencies, especially from a cost perspective. And here, it would be remiss of me not to just mention a few numbers because, I'm a numbers person. So if you're just looking at, let's say, 2 warehouses, so let's say a go down in Mombasa Road and let's say a grade A facility, which is currently what we have in Tatu. If you were to take 1,000 square meters within the two, in Mombasa Road, you'll be paying somewhere around $4 per square meter. What we have is around $6.5. So on 1,000 square meters, you're $4,000 per month on the go down, $6,500 for a grade A facility. But then again, the thing about warehousing is you're not, buying the floor plate. It's a volume game. For the go down, you can only stack up 4 levels, and in each level you can only do, let's say, 500 pallets. So going back to the go down, that's 2,000 pallets. You're paying 4,000 per month. So per pallet cost, it's $2. Coming to a grade A facility, you can stack up 9 levels. Still at 500 pallets per level, that's 4,500 pallets. Cost per pallet is $1.40. So whilst it may seem you're paying more, if you're able to utilize, the space, then your cost is actually around 45%, cheaper. Then with also looking for those efficiencies, being in a, well-built, with good circulation, dock levelers, that quick turnaround of inventory, one of the things that one of our tenants actually pointed out is the fact that they were able to actually save close to 20% on their staffing costs. So net, you are paying more rent, but then from an operational standpoint, it's actually cheaper. And we do believe as our economy grows, and this is not just Kenya, but also the wider East African region, there's going to be a move towards seeking those operational efficiencies, especially from a cost perspective. Then I'd say the third one, you have seen a push towards sustainability and ESG. And a lot of the players who are looking to build institutional grade industrial real estate are doing green assets. And so for us, that we do believe is going to be a key trend also going forward. That push for green assets, you ideally have to build institutional grade industrial real estate, which is the position that we are currently in and doing. Yeah.
Excellent. I can see Kura is on his feet, so he's probably signaling us that our time is up. Do we have a chance for Q&A if there's one question maybe? Any burning question you can address? Well, since there's not. So yeah, I'll thank Barrack and Cynthia, and thank you to the audience as well for paying attention to us.